So a very warm welcome to all of you to the 2021 edition of the Adam Smith workshop. This is a 3-day workshop. Today is the second day. So for those of you who were not here yesterday, let me tell you again that we have a very exciting program. We received 550 submissions, out of which we selected 21 papers. So a selection rate which is slightly under 4%. This means that, of course, there were many excellent papers that we could not include in the program, but it also means that the papers that you are going to see today were selected from a very large group and should be exciting and promising for furthering your own research agendas. Okay. So each day of the conference is going to be 4 hours, 2 o'clock to 6 o'clock Central European time. And during each hour, we have one paper being presented with 25 minutes for the author, 20 minutes for the discussant, 10 minutes for questions from the audience, and the last 5 minutes to transition from one paper to the next. Okay. In terms of Zoom information, there are 2 parallel sessions. So depending on which session you picked, asset pricing or corporate finance, when you registered for the conference, after my initial remarks, you will be automatically switched to that room, but you can switch between rooms at any point during the first 3 hours of the day. And then for the very last session, it's a joint session between the asset pricing and the corporate finance people. And that session, you will automatically be moved into the room for the joint session. When the conference ends around 6 p.m. Central European time, there will be breakout rooms where you will get a chance to chat with people. You can choose which breakout room to join. There'll be one for each of the papers that has been presented. So it's a chance for you to chat with the presenter, with the discussant, and other people who wish to join you in that room. So in closing my remarks, let me thank again Mandy Chan and Gabby Schachter, who arranged and who made it possible for us to have this conference despite the pandemic. And I invite you to enjoy the next 4 hours, where the asset pricing session will be chaired by Irina Zviadadze, and the corporate finance stream will be chaired by Johan Humbert.
Okay, let's get started. So welcome to the joint asset pricing and corporate finance session. We are going to have Lorenzo Bretscher, who is going to present his paper, Marking to Market Corporate Debt. Lorenzo, you have 25 minutes, and I will indicate when you have 5 and 1 minute left. Please go ahead and please share your slides with us.
So thanks so much for putting our paper on the program to the organizers, and thanks for Irina for the nice introduction. So it's already getting late in the afternoon, at least for the European-based people in this call. And so it's a good thing that this is a very, very simple paper. But nevertheless, let's see, and let's hope we have something to say. Okay, so most importantly, this is joint work with Pierre, Feldhutter, Andrew Kane, and Lukas, Schmid. Okay, so let me try and motivate this paper a bit. So there's a huge literature in finance and also in economics that revolves around corporate debt. Now, however, we think at least that it's not very well understood. So textbook finance implies there's a strong link between leverage and returns. Nevertheless, empirically, we don't really see much of that. Moreover, there's the so-called credit spread puzzle, right? That is, corporate bond spreads appear too high relative to standard model predictions of structural models. Standard models of corporate investment imply that Tobin's Q is a sufficient statistic of corporate investment. However, what we find empirically is low coefficients on Q, which in turn imply unreasonably high adjustment costs and significant explanatory power for cash flow measures, which shouldn't be there, theoretically speaking. And last but not least, there's the distress risk puzzle. Returns are negatively related to measures of distress, opposite to what theory would predict. So these are 4 examples where we feel at least there's some sort of a wedge between theory and empirical findings. Okay. Now, one important, or what we think important observation is, and we're not the first one to make this observation, is that theory makes predictions about market values rather than book values of debt, while empirical measurement often reflects book values. Okay. And so this opens up the question about potential problems with this. Is it a problem with theory, that there's this misalignment of theory and empirics, or maybe there's measurement is an issue, that because we make predictions about market values, but we measure debt in book values. So this paper is about measurement. Okay, and what do? We compile a comprehensive data set on monthly book and market values of corporate debt at the firm level, and in an attempt to enhance measurement of debt at the firm level. Okay, we first document significant discrepancies between market and book values, especially for distressed firms, as you would expect, and we provide novel rules of sums regarding debt adjustments based on standard data sources, so that allow you to use standard data sources and sort of come up with predictions of what the corresponding market values should be. We revisit and confront then empirical puzzles with this enhanced measurement of corporate debt, and in many instances we find little puzzling evidence. Okay, so at the heart of the paper is obviously the data. And so what is the data? So we combine data from several data sources to construct this firm level market values of debt. The first 3 are very standard. We use balance sheet, firm level balance sheet information from Compustat, quarterly and annual. We use firm level share price information from CRISP, that's monthly. And then we have corporate bond information, and we need pricing information for the market values and static information about these debt contracts. And the static information comes from Merchant, FISD, and the pricing information comes in the early part of the sample from the Lehman fixed income database, and in the latter part of the sample from the WRDS bond returns database. Now, importantly, we add yet another data set to our study, and that's going to be important for at least for some of the results. We also use pricing and static information for corporate loans. We use the Loans Indication and Trading Association market-to-market pricing service for secondary loan pricing data. Okay, so that's the pricing database, and DealScan delivers the static cross-sectional information, if you wish, on corporate loans. Now, what is the coverage within our sample? So for the firms that we observe, how much of their debt, total debt, do we actually observe in terms of market prices? So first, the sample period is March 1998 until March 2018. And we restrict our analysis to non-financial and non-regulated firms, fairly standard. In terms of coverage within sample, the corporate bonds account for an average of 59% of the book value of total debt from that is measured through Compustat, and the book value of loans that we observe accounts for 30% of this total debt measured by Compustat. So that is our sample covers on average 89% of the quarterly value of total debt, as is available through quarterly Compustat. Now, the second question is to sort of the extensive margin of our coverage, so how representative is our sample. We have on average a bit more than 1,200 firms, which seems fairly low compared to the CRISP CompuStat universe, right? Now, our statements are going to be about debt, corporate liabilities, right? And so it's sensible to think about the coverage of the total liabilities in the CRISP CompuStat universe that we have in our sample, okay? It turns out that we do a decent job in terms of covering the liabilities out there. On average, over our sample years, we cover roughly 77% of the book values of liabilities in the CompuStat CRISP universe. So even though our numbers of firms is lower than the total numbers of firms in CRISP CompuStat, we focus on the firms that, you know, like that together combined make up for the bulk of part of total liabilities in CRISP CompuStat universe. So our study then sort of revolves around a few key variables. The first one is the book value based leverage, or sort of the traditional leverage as you can find in many corporate finance, but also asset pricing studies, okay, which is simply defined as debt, the book values of debt quarterly divided by the sum of the book value of debt plus the equity value in terms of market values monthly measured. And then we propose and, you know, potentially enhance measurement of various candidates that are, or key variables that are interesting and at the heart of many studies in our field. So first, an obvious extension is to think about the market value based corporate leverage, which is just adding the blue bit to the traditional book value based leverage, right? Which is essentially swapping book value of debt with the market value of debt. The second market value based leverage is then the so-called structural leverage, which is often used in structural models of credit risk, which is one of the models that I will discuss in a few slides. Okay. Then we're also going to think about Q, Tobin's Q. Here we can again improve measurement by swapping the book value of debt with the market value of debt. And last but not least, we can then form an interesting new variable, which is the so-called market to book debt variable that potentially contains information about various things at the firm level, which is just the counterpart to the market to book or book to market equity measure proposed by Pharma French. All right, so this market to book debt measure and this cross-sectional distribution thereof is here plotted in one graph along against time in for our sample period. Okay, so you can see in red the median, which hovers around 1, as you would expect. So most of the time, market value of debt is not, at least for the median, not very different from the book value of debt, and 2 alternative confidence intervals. In green, 25, 20, 75%, and in blue, 5 and 95%. You can see that during the financial crisis, this ratio drops below 1. For some firms in the cross-section, significantly below 1. This is expected because credit risk increases, among other things. And interestingly, in the latter part of the sample, you see that the median is actually above 1, which goes hand in hand with the zero lower bond crisis and long dated bonds that have essentially high duration because they and then when interest rates drop, this leads to increases in prices with high coupons. Okay, so long story short, while the median is maybe not drastically different in normal times from 1, at least some parts of the cross-sectional distribution deviate substantially from 1. That is, put differently, market values are sometimes substantially different from book values at the firm level. Now, if you sort of plot the same graph for subsamples, and on the left you see the speculative grade debt, and on the right you see investment grade debt, you get what you would expect, namely that the movements are much more erratic for debt that is rated below BBB. High rating debt or investment grade debt on the right-hand side, you can see that these lines are much closer to 1, and if anything, at least for the time after the crisis, they're substantially above 1. In the first part of the paper, we then proceed and come up with so-called rules of sums. That is, we run simple regressions, and here for the market leverage, corporate finance market leverage, on the left-hand side, on the right-hand side, we have polynomials in book leverage. Okay, and we then see what polynomial best describes the market leverage. And from the R-squared, it's sort of hard to say. It seems that after order 2, there's no more improvement. The standard deviation of the prediction error tells a similar story. For n more than 2, there's not much gain. Okay. In an attempt to test these rules of sums, we then calculate asset returns. We can easily do that for our sample because we have market valuations of loans, bonds, and equity, and we also have the corresponding returns. And so the return on assets is just the market value weighted returns of loans, bonds, and equity. And then we come up with candidate asset returns by unlevering equity returns, assuming that the beta of debt is 0. Okay, a standard practice in many empirical papers, including one of my own. And on the left, you see essentially rating-specific histograms for the deviation in what we call true asset returns, that is, these asset returns calculated this way, and the unlevered returns using this shortcut of setting the debt beta equal to 0. On the left, you see the results or the distribution for each rating category if you use book leverage. And you can see that, yes, they are mostly centered around 0, but sometimes, at least in the tails, you substantially deviate from 0. Okay. If you then use market leverage, actual market leverage, that's the middle graph, you can see that you do much, much better, at least for investment grade. Okay. The same story or the same conclusion holds in the last picture when you use our rule of thumb for market leverage. Now, why doesn't it hold for speculative grade? Because the assumption, the implicit assumption that essentially debt is priced at the riskless rate is clearly wrong. Okay, and so one conclusion would be if you want to make statement based on unlevered returns, first, it pays off to have a better enhanced measurement of leverage, namely market leverage or our rule of thumb. But then even in this case, you should be cautious in your statements. The most precise statements will only concern investment grade firms. Okay. We then also have, and I'm not going to show this in this presentation, a rule of thumb for asset volatility. Again, given that we have asset returns, we can also calculate asset volatility at the firm level. And we're going to use this rule of thumb of asset volatility in our next exercise when we revisit the credit spread puzzle. Okay. So the question is, can a structural credit risk model, a la Black-Cox, explain average credit spreads? The puzzle has it that the model implied spreads are too low vis-a-vis to the actual spreads in this first row of this table. Now, it turns out that a very recent paper by Goldstein and Yang had a very similar idea, similar to our idea. They also say, look, and following up on a paper by Peter Feldhutter and Stephen Schaefer in the RFS 2018, they say, actually, we should use market data to measure adjustment factors, rating-specific adjustment factors of leverage, and essentially use these pseudo market prices for each rating category and revisit the credit spread puzzle. And they conclude there is indeed a credit spread puzzle. That's the first line. Okay, that's replicating their results on our sample. Now, we share the same idea, and we think very much along the same lines, but we not only use bond data, but also bank debt data to assess the market value of debt at the firm level. Moreover, we can use actually the market valuation of debt for every firm individually, whereas they actually use rating-specific adjustment factors. Okay. If we do this, it turns out that adding bank debt information makes quite a bit of a difference, and the credit spread puzzle starts to disappear again. And you can see if we go down from row 2, 3, 4, and 5, we start to add more information, and eventually in the last row, we essentially use the actual market leverage and asset volatility. And what we conclude is that we're almost perfectly replicate the actual spread from the data. If anything, only for the AA bin where we are slightly different in our model implied spreads compared to the data. In the next part of the paper, we then revisit Tobin's Q investment regressions. And in the standard OLS regressions of investment on Q, we see that R squared increases for market value based measures, and the coefficients are higher compared to traditional Q measures. And that's not on the slides, okay? But so R squared increases, good news, and coefficients are higher, again, good news, because the implied adjustment costs in the Q model are lower, which tend to be unreasonably high with the coefficients you get from the data. Now, however, we know that OLS regressions might be biased because we measure average Q rather than marginal Q. To address this, we use the Erickson-Shang-Whited higher order cumulant estimator, and we essentially estimate a system of equation. Here, rho squared down here measures essentially how well the true unobservable Q explains investment. So that's an R square, if you wish, in this dimension. And tau square measures how well our Q proxy explains the true Q. All right. Now, we have two candidates for investment. One is total investment, and that includes investment in intangibles as proposed by Peters and Taylor. And I star is the traditional investment, excluding intangible investment. We also have a total of 4 candidates of Q total, that is, again, including intangibles, as in Peters and Taylor. Q is just the traditional Q. And then we have, for both versions of Q, also the market value-based versions, okay? And C total is just a total cash flow measure. Now, there are 2 important messages from this table, takeaways. Let me walk you through. So first of all, if you compare the regressions from the traditionals measures, book value-based measures with market value-based measures, you can see, so that is column 1 to 2, you can see that both R square measures, if you wish, fit measures, they improve. That's also true for the traditional investment, traditional Q relationships, right? Again, both rho square and tau square improve from going from column 3 to 4. Moreover, if you focus now on the row with cash flows, you see that for the total investment, so that is the part where we include intangible investment, you actually see that the cash flow coefficient becomes very close to 0 and statistically insignificant, as one would expect from theory. This is not quite true for the traditional investment, but nevertheless, it becomes less significant. And the coefficient moves towards 0. In the next exercise, we then look at return sorts, and not only equity return sorts, but debt return sorts, loan return sorts, bond return sorts, and asset return sorts. And we do this in the leverage dimension, market leverage sorts. Okay, we find that there is an intriguing sort across the across equity returns. There's a bit of a sort, much weaker though, in debt, only driven a bit by the extremes. Not much going on in loans. Again, a bit of a sort in bonds, and not really anything going on in assets, as one would expect from theory. We can then, admittedly, we only have 21 years of data, so it's a very recent sample. Nevertheless, we can do double sorts on market leverage quintiles and book to market equity quintiles. And what we find is, in our sample period, that if anything, the data suggests that there is a bit of a leverage premium, but not so much of a value premium. I mean, you know, the signs are correct, but you know, there's at least no statistical evidence. We can find one we control for market leverage, which is a bit, which is in line and consistent with this recent paper in the JF by Doshi and co-authors. Last but not least, we then also look at default risk and the value of debt. Now, first we can do two things. The first part of our analysis is we're gonna use existing default predictors, such as the KMV or these measures by Eisfeld and Jean-Olivier Weil. And we find that the market value based versions of these measures are performing better. We can see that R squares improve, and in general, the fit improves not only within 1 quarter, but also within 1 year or 2 years. What we also sort of examine is whether our market to book debt variable that we propose contains any information about distance to default. Why? Because let me put that differently, it's sort of, I guess, is intuitively clear why it might contain information, because the market price should reflect this distance to default. At the same time, we find that this market to book debt variable is very low in correlation with other distance to default measures. As such, it is a promising candidate that could potentially contain information that is orthogonal, hence new, compared to existing predictors of bankruptcy. And that's exactly what we find. Log likelihood tests show that you know, like, you should absolutely not throw away this information, and it makes sense to add these additional predictors. And that's again not only true for default within 1 quarter, but also within 1 year or 2 years. Last but not least, we have market to book debt sorts, which, as we have just shown, is a promising candidate for predicting bankruptcy or default, I should say, not bankruptcy. And we find it has some intriguing sorts also in the cross-section of equity returns and bond returns. And importantly, there seems to be a positive relationship between financial distress and returns, at least when financial distress is measured by this market to book debt ratio. And this, if anything, doesn't lend any support for the distress risk possible. So I think I'm out of time, right, Irina? Yes. So we compile a comprehensive data set on market values of corporate debt at the firm level, and we document that there is quite a bit of action when we use this market value-based measures. And our main conclusion is measurement goes a long way, but we have to further think, and it would be interesting to think about what our findings imply for theory. Thank you very much. Sorry for going over time. I couldn't somehow see your messages.
No problem. It's on the slide over time. It's okay. So it's our pleasure to have today with us Pierre Collin-Dufresne from Ecole to discuss this paper. Pierre, you have 20 minutes, and I will remind you when you have 5 minutes left.
Okay, thanks a lot for inviting me to discuss this ambitious paper. You know, what they do in this paper, as you've seen, Lorenzo did a great job presenting, is they put together a huge data set. They have about data on market values of bonds and loans for about 1,200 firms from 1998 to 2018, and they provide approximations, rules of thumbs to compute market leverage based on book value for people who would not have access to their data, and that could be very useful if you want to unlever equity returns to get asset returns. Of course, if you got their data and if they make it available, it's probably even better to use their data rather than to using rules of thumbs, but that would be useful. And then, they overturned four, not just one, but four asset pricing puzzles related to corporate debt, right? So they find that, investment cash flow sensitivity regressions don't work when you substitute market leverage. So they, that's in contrast with Feldhutter-Pedersen's paper and a very large literature following up. And then they find no evidence for the credit spread puzzle in contrast to Huang and lots of literature. No evidence for the financial distress puzzle, no evidence for the value premium puzzle, and they all get that just by essentially changing from book value to market value of debt. Then they also improve bankruptcy predictions, and they identify a new leverage premium in the cross-sectional stock returns. So as you can see, they do a lot in that paper. And my first comment is write 5 separate papers. It's like you have an 80-page paper where you overturn 4 major ideas. You send it to an editor, he's going to send it to one expert on the credit spread puzzle, one expert on the investment cash flow sensitivity. You're going to get back 30 pages for each. You're going to end up with 189 pages or 200 pages once you're done. So it'll make life easier for everybody, including discussants. They'll only have to discuss one puzzle. Referees, they'll only have to referee one puzzle. So I think if you address such big problems and you solve them, overturn them, I think it may make sense to separate your paper. And I like small papers. So that would be my first comment. It would also be helpful because then you could address each puzzle in a bit more detail and probably address some of the subsequent literature that may have something related to what you've done. So I think that would be better. So in the spirit of this first comment, I'm actually only going to focus on one mostly, which is the credit spread puzzle, which I used to follow closely in the past. And so your paper sort of forced me to think back about that puzzle. And right now, your paper reads more like a discussion between Feldhutter and Schaeffer, and then Bay, Goldstein, and Young. And this seems like a rebuttal to this line of discussion, which I think for the average reader who doesn't know these 2 papers would actually be quite hard to follow. So my attempt will be to sort of get people to figure out what's the discussion between these papers and what's your solution, or why you solve the credit spread puzzle. And my first question was, is it really the case that you just use market book, market value of debt, and that will solve the puzzle? And I went back and I looked at Huang and Huang's paper, and if you can see my slides, you can see that they say that you should essentially calibrate, right, to the market value of debt. And then I went back and I read sort of the paper that I wrote with Bob Goldstein and Long Chen, and I saw that we considered 3 proxies for leverage. The first was book leverage, indeed. And then the second one was market leverage, defined as the market debt plus market equity. And then the third one was sort of this inverse distance to default, which we define as, like you do in your paper, something related to market value of debt plus market value equity to book value of debt. And so it seems like, and we computed market values based on Lehman Brothers data set, which is what we had available. You have a much better data available. But then I thought, okay, why is it that using market value of debt actually didn't have any impact on the credit spread puzzle at the time in the way that Huang and Huang defined it? So let me maybe go back and remind you guys of what is the Huang and Huang credit spread puzzle. The credit spread puzzle basically starts from an observation, which is if we look at cumulative default rates for investment grade firm, let's focus on BBB firm, let's look at the 4-year horizon. The cumulative default probability is around 1.6%. And then, recovery rates on those investment grade names is around 45%. which means that, you know, the cumulative expected loss on investment grade firms is about half of 1.6, so 80 basis points over 4 years, which translates on a per year value of 20 basis points. So the per year expected loss for going long a triple B bond is around 20 basis points. If we were risk neutral, right, then the spread should be 21 basis points. However, average credit spreads are much higher. Average credit spreads are around 160 basis points if you measure them relative to Treasury, or they're about 100 basis points if you measure them relative to AAA. So that means that only 20 basis points of 160 basis points is compensation for expected loss, or if you measure relative to the AAA benchmark, only 20 basis points of 100 basis points is compensation for direct expected loss. And so the difference, well, that's got to be compensation for something else. So obviously we don't think investors are risk neutral. So the question obviously is that difference, that unexplained 80 basis points or that unexplained 130 basis point, depending on your benchmark, is that compensation for systematic credit risk premium, you know, or is it maybe compensation for something else, like, you know, a tax differential, as some have argued, or illiquidity, which we might think might also affect credit spreads. So the initial idea was for researchers to use calibrations of structural models, of which we have many, based on, you know, starting from the Merton model, the Black-Cox model, the Longstaff-Schwartz model. There's lots of different models with more and more bells and whistles. And there's a very nice paper by Helge and Huang. We tried to calibrate these different models, and pretty much the predictions of these models were all over the map. That is, some models underpredicted, some models overpredicted, some models were roughly in the ballpark, and so we didn't get a very clear picture. But then, you know, Huang and Huang come along and say, well, wait a minute. One thing we know from the previous slide is that investment grade names have very low historical average expected losses. So let's just make sure that all these different implementations of structural models, they match these low expected losses. And, you know, lo and behold, what they found, it was, I think, a great contribution of their paper, is that once you calibrated these models to make sure that they were consistent with the historical loss experiences on these bonds, then they all gave very consistent predictions, and that were way below the credit spreads we observed. And so this is the famous picture from their paper, where you can hear, focusing on the triple B, you can see that the black bars, that's the expected loss, you know, 20 basis points that I said to you, right? So this is how much we would charge as a spread if we thought investors were risk neutral. And then the sort of shaded big bars here, those are the actual observed spreads. And then those third bars there, this is the predictions from these structural models. And so you can see that essentially the structural model predicts that if you have a 20 basis point expected loss, then the risk premium component, you know, only roughly doubles the spread, but doesn't get close to matching the data. Okay. Now, here's a bit of a, you know, complicated slide, but if you go slowly through this, then you will understand the point of my discussion, which this is, let's just think of the Huang and Huang calibration for the simple Merton model and why they get this nice result. Merton models has an asset value process. Okay, that's log normal, classic Black-Scholes model. Calibrated, you know, there's parameters. Delta is the payout ratio, R is the risk-free rate, sigma is the volatility, theta is the Sharpe ratio on the asset value. Okay, so the premium per risk on the asset value. Defaults assumed to occur when this asset value falls below some default barrier, B. And if default occurs, then the bond recovers 1 minus L. Okay, now you can solve then for bond prices using the usual Merton model, where the bond price is going to be the risk-free bond minus the value of the put, and the put is going to be priced by Black and Scholes. Okay, so it's going to depend on all these arguments. However, when you compute the implied credit spread, you can also do a little bit of algebra and rewrite the spread in the following way, where the spread only depends on the loss given default, the P measure probability of default, which of course will be the probability under the physical measure that the value falls below the barrier, and the Sharpe ratio on the asset value. Okay, and so now you can see that even though the model has many parameters, right, the actual spread only depends on these three numbers, which means that if you fit your model to match the historical probability of default, if you fit your model to match the historical recovery experience, then your model only depends on the Sharpe ratio, which in this model, they choose a classic number of 22%. So in other words, the spread predictions of the structural model will then not depend at all on leverage. Surprising, but not so surprising, because the leverage enters the p-measure probability of default. And if you calibrate your model so that you match the p-measure default probability, then spreads actually don't depend on leverage. Okay. How does market leverage, book leverage actually enter to play in these different calibrations? It's because in these models, we don't actually know where the default boundary is. Sure, in the original Merton model, we chose the default barrier to be the face value of debt, but that doesn't work because companies have very complex liability structures. So we end up having to make an assumption. And typically the assumption is that this default boundary is specified, the unobserved default boundary is specified as some fraction d of the book value of debt. And we need to solve for d. And then of course, the p-measure model probability depends on this d, which needs to be solved for. And if you calibrate d so that you match the empirical observed default probability, it doesn't matter, book leverage will not matter. If you replace book debt by market debt, you will just have to change d to match the physical measure default probability, and book or market leverage will have no impact on the spread. So what's going on in their paper? Well, actually, what they do is they do not actually match the historical probability of default. They choose a different calibration approach, which is might also be sensible. And their view is that essentially the historical average default probability is too noisy an estimate of the true one, because we see too few investment grade defaults, and therefore they don't want to rely on this average observed in history. They use a calibration technique proposed by Feldhutter and Schaefer in their paper. And basically, when you're done with their calibration technique, you essentially end up with an actual p-measure probability of default that's much larger, more than twice larger than the historical average. And so their solution to the credit spread puzzle, to the Huang and Huang version, is, well, just basically increase the amount of risk. If you increase the amount of risk, then sure, you increase the expected loss and spread should be higher. So the question will be whether we think, or whether you think, that the calibration approach is a good one. Okay, before I go and explain the particular calibration approach they use for their paper, let me just make one remark about the Huang and Huang version of the credit spread puzzle. Notice that the Huang and Huang version of the credit spread puzzle, right, fixes loss given default, fixes pi, and therefore depends highly on your choice of theta, which is the Sharpe ratio of the asset value. And so what this table has, it has a whole bunch of different spreads you can attain in the sort of very basic model, where you always will match that very low 20 basis point expected loss, i.e. loss given default and default probability are fixed, but we're just changing the Sharpe ratio. And what you can see is you can generate very high spreads in a sort of basic Merton model if you agree that the underlying asset value has a lot of systematic risk. Okay. So the true, the sort of amended version of the Huang and Huang puzzle is Sharpe ratio, spreads on corporate debt are surprising if we try to match very low expected losses, and if we take into account that for the median investment grade firm, that the Sharpe ratio on the asset reflects quite a sizable amount of idiosyncratic risk. In other words, if you were trying to price a bond written on the market, then you could match very high spreads even in a Merton model. Okay? So to sort of put some more general perspective on this Huang and Huang puzzle, right? I gave you a very specific example, the Merton model with very specific parameters, but you can also just think of it in the sort of very broadest model where price is the expected value of stochastic discount factor or pricing kernel times payoff. And obviously the payoff, you can also break it down using the product covariance and the product of the expectation. And you can see then that price is essentially expected payoff minus covariance between pricing kernel and payoff. The Huang and Huang calibration fixes the first part. The expected payoff is fixed. We're matching historical loss experience. Therefore, how do we manage to solve the Huang and Huang credit spread puzzle? It has to be that we need to introduce more covariation between the pricing kernel and loss given default. And this is one way to understand the Huang and Huang result, which is that as they were calibrating several different structural models, they got the same predictions, because basically all the models that they're considered had essentially very, very restrictive pricing kernels, basically with constant risk premium. So that the different models that they were using, calibrated to fit the first part, didn't generate any cross-sectional variation across models in the second part, because there was no covariation between pricing kernel and expected payoff. And so this was sort of the starting point of our paper with Bob and Long, where we said, well, there's this thing called the equity premium puzzle, where we've tried to solve it by introducing lots of variation in risk premium. if we pick a pricing kernel that's fit to equity side of the premium that has lots of time variation and risk premium, then we can actually explain the credit spread puzzle, simply because firms tend to default more in bad states of the world, which are also the states that tend to be more costly. And therefore, we can actually increase that covariance term substantially, which will lower prices and increase spreads. Okay? Now, this paper follows a different route. They say, well, we actually don't like the historical estimate of expected loss on investment grade, because we think that there's too few defaults in investment grade firms. So therefore, what we're going to do is we're going to rely on the default history across all firms. Low rated, high yields, very risky, non-risky. 5 minutes, thanks. Right? And so the way they do it is they essentially rely on the model default probability, and they assume that all firms share the same D, that unknown distance to default, if you want. And then essentially assuming that all firms default at the same fraction of the observed, of the initial debt value, they solve for a D that minimizes model probabilities versus historical probability experiences across all ratings and across all maturities. Okay, and so of course, we're now getting some D that sort of helps match with the same model default, the very high default probability of high yield firm, the low default probabilities of low yield firm. We get a D that's of course not a great fit for all firms. And that D will mean that for the calibrated model, the predicted default probability for investment grade firms is much higher than the historical experience. And of course, the question is, which estimator do we believe more? The low historical average on investment grade firms, or their calibrated model estimate, which is about twice or 3 times larger? And of course, that's going to depend on whether you buy the assumption that all firms, whether investment grade or high yield, default at roughly the same fraction of their initial debt value. So, and of course, also on the ability of the model to match the cross section of default probabilities across all firms. Right? So a couple of comments, and then I'll stop. Well, first, one thing, of course, is you see that for this calibration method, you actually need some input default probability. And there's sort of a little trick that they use, which is they use data from 1920 to 2012, which of course increases, by the way, a huge amount, the probability of default. But then they try to match data on spreads from 97 to 2018. Obviously, if you look back and you look at the spread history, these are the spreads in the 20s. So the spreads in the 20s, as you can see, are much, much larger than the spreads today. And so you probably should match the spreads data with the default history that you're using. Now, it turns out, which is kind of funny, that if you take the average spread from 1920 to 2012, it's not actually that different from the average spread in the recent history. And that is because essentially we get lucky that when you take that average, you increase the default rates a lot because there are lots of defaults in the 1930s. You would also increase the average spread a huge amount because the spreads were much higher in that period. But it turns out that you also get as a benefit that period of extremely low spread, which is the post-war period where spread were anomalously small. So if you just added this experience to increase your p-measure default probability, then you would increase both the average spread a huge amount and the default probabilities. But because you increase the whole thing, you get a large contribution to your point estimate of the default probabilities while not raising the average spread too much. But wouldn't it be though ironic if the Merton model with constant volatility, no jumps, everything constant risk premium were to price really well the bond side of things, when the consensus, I think, on the equity side is that we need time-varying risk premium, stochastic volatility, time-varying disasters, long-run risk. I mean, we'd be in a strange world, right, where we think the right model to use for corporate bonds has constant volatility, no jumps, constant risk premium. And yet when we're pricing the equity side of things, we need, right? So I think if that was the case, we would point towards quite a bit of segmentation. One thing I want to point out is there's nice data on credit options. And you can see that if you use the simple black box model that they use, this would be the predicted credit smile, the red line, where in the data, that's the credit smile. So you can see that I think the black box model is quite misspecified as a model of credit risk. Now, an alternative approach you might use to get robustness in your estimates for the actual physical, because the thing is the starting point is true. We don't know what is the right estimate for the physical default probability of investment grade firms, right? So trying to get robustness from that is difficult. I should say one thing about this picture, right? You can have two approaches. You might think we live in a stationary world. The physical default probability is actually constant over time. And so extending the data a lot is the right way to go. And average spread seems to be fairly constant. But another worldview you might have is that we live in a non-stationary world. There's lots of variation in risk premia. There are these periods of time where risk premia are very high, risk of default is very high, spreads is very high. And there are these other periods of time where risk is low, risk premia are lower, right? So a model that would call for time variation. I think two different pictures of the world. Maybe one way to get more robust estimates is to do like in this very nice paper by Huang, Nozawa, and Shi, and to look to international data. And these guys use data from many different countries, and they find evidence more consistent, I believe, with the Huang and Huang version of the puzzle. Okay, I think I'm out of time. I had a few more comments, but I'll leave them for the authors. So I think to conclude, I think this is an amazing data set, lots of great work, which I think can bring lots of new insight. For example, also on relative pricing of loans and bonds, which I think would be a great thing to think about. Controversial findings about 4 well-known puzzles. As you can see, I spent a lot of time in my discussion just on one, so I think it might be nice to break it down into 4 or 5 separate papers, and I would suggest digging a bit deeper into each of the puzzle solutions. Thanks.
Thank you very much, Pierre. And Lorenzo, would you like to respond quickly to the comments, and then we will move to the questions. So anyone who would like to ask a question, so please indicate through the raise hand option feature on Zoom.
So first of all, thank you very much, Pierre, for a fantastic discussion. So I don't have too much to say. I just want to essentially respond to this credit spread argument that you made, puzzle. And, I agree with you, with essentially everything what you said. I guess what our paper, or the statement in our paper, and maybe we have to put this phrase this differently, is obviously conditional on the methodology, right? And it's not our it's not the purpose of the paper to sort of propose a new methodology or defend a new methodology, or taking too much of a stand on the right methodology in addressing this puzzle. It's just the fact that there is this discussion going on between 2 and potentially more papers and all the arguments are based on this methodology that you outlined very nicely in the second part of your discussion. But everything is true. The main assumption is that we take a stand on a common default boundary, right? And that allows us to use much more data. And as Stephen and Peter argued in their RFS, that has value in using the full cross-section of data, because not only the low-rated bonds, but also high-rated bonds arguably have a lot of information that one can exploit about credit events. Now, a follow-up paper on this 2018 RFS was this paper by Goldstein and Yang, and their argument is that if you use market values, you essentially are back in Huang and Huang world where the credit puzzle arises, right? And that's conditional on the same methodology. And I guess our point in our paper is maybe a bit smaller than what you anticipated in your discussion, right? We essentially say we want to contribute to the discussion conditional on the methodology. And here, actually, if you use what we think a more comprehensive and enhanced adjustment for market values, you actually, recover the findings that to some extent were presented also in Feldhutter and Schaefer in 2018, right? That is, I guess, the marginal value that we add. And I don't want to claim that, we can use this very simple and stylized model to essentially address and solve everything in the world. And I very much agree with you that there's probably much more higher powered machinery needed to do so, right? So in that sense, I think we're on the same page. And you know, I guess it's a matter of framing, and it's also, you know, and that's clearly on us, right? So we have to be very clear there. And but you know, like the other point that, you know, that we have sort of controversial findings, and we should maybe separate them. Very happy to do so. We have to think. We're still thinking about how to best present these findings, right? Initially, we saw, you know, like, this is the data, let's put it out there, and let's just see what the data tells us in our conditional, our sample period, right? Now, you know, is value premium there or not? Is leverage premium there or not? Again, as well as our statements about the credit spread puzzle are conditional on methodology, our results are conditional on the sample, right? And this is arguably shorter or clearly shorter than, you know, compared to other studies, because we also have much better data that is available only over a shorter time period. So that's what we have to live for. I guess the bigger point that at least I would like to bring across is, you know, we have this data, it seems to have some bite, we should use it, right? And I think that's the main message. Thanks.
Okay, do we have questions from the audience? I think we have time for maybe 1 or 2 quick questions. Okay, so if there are no other further questions, I would like to remind all the participants that in a matter of a couple of minutes, we will have breakout rooms, 1 room for each paper, and people who are interested in discussing further could join these breakout rooms. And we hope that presenters and discussants are going to be available as well. So the time allocated for discussions and breakout rooms is 45 minutes. And then the Zoom session is going to be over. And at this point, I would like to thank all the presenters and discussants for their great job for sharing with us their research findings and insights. Thank you very much. And we are looking forward to see all of you tomorrow for another set of great papers at 2 p.m. Thank you very much.